Inflation data comes out tomorrow, December 13th, 2022, and it is going to determine a lot about how 2022 ends. CPI data, or the Consumer Price Index, is going to let us know at what level are consumers paying prices for goods, which ultimately, in fact, it implicates how much inflation is there. Now, inflation came in at about 7.7% last time, which was a pretty steep decline from what estimates were projecting. Some people were projecting 8.1, some people were projecting 7.9, 8.2, and it went all the way down from 8.3 to 7.7. The question now is, how much lower can we get? Can we get from 7.7 to 7.4? Can we get from 7.7 to 7.1? Is there a world in which we hit 6.9, which would make the universe go crazy? Because 6.9. But the question is if we're going to see what happens. Now, a couple of things to keep in mind about how I think about inflation and how I think the macro will respond to it. If we get below 7.2, I believe the market is likely going to rally. On Wednesday, Jerome Powell is actually going to be speaking about inflation, and that meeting matters a hell of a lot more than the actual inflation report, because his statements on if he's being hawkish or dovish is going to influence the market, and I'll be live streaming that as well. Now, last time Jerome Powell talked, which was at a more informal meeting about a week ago, he sounded pretty dovish. He even quite literally said that the possibility for a soft landing is possible. Now, he's not supposed to say that if it's not possible, so maybe he's just blowing smoke up our asses, but there is an argument that that he could be correct around if inflation goes down. The question around a soft landing or a hard landing is contingent upon if Jerome Powell actually thinks that inflation going down leads the Fed to not have to raise interest rates as high as they were doing before. If we get below 7.3, 7.2, I believe the market will rally, but I do believe it'll be a short-lived rally, because what's going to happen in 2023, at least from the macro, most investors feel, is not going to be the most positive, specifically for earnings for companies and the market's reaction to earnings, especially the S&P index, which right now is trading 20 times forward PE, price to earnings, historically should only be trading 14 to 15 times, which one could argue is overvalued. And earnings coming down for companies, even if CPI goes down, even if inflation goes down, will not be enough of a catalyst to sustain a new rally up into the 4,800s of the S&P, which was our all-time high. So it's important to understand this. Now, after 4 consecutive jumbo 0.75 percentage points interest rate hikes from this article, it says, the Federal Reserve finally seems to be making some headway in its war with inflation, as we've seen inflation going down. The question becomes around if we're going to have a mild or severe recession, as I was talking about a soft or hard landing. And if the Fed thinks that interest rates going down or inflation going down to, let's say, 6.9, 7.1, 7.2 warrants a 50-point basis hike versus a 75-point basis hike, that's going to be good, because interest rates and the growth at which interest rates are going to go up is going to start to decline a little bit. The question becomes if they ultimately have a pivot, and that pivot and the pivot means they stop raising interest rates. That depends on a lot of other factors, one of those being the labor market. So, as this article says, there was another somewhat conflicting data point at the beginning of this month. The November jobs report came in much stronger than expected, with the economy adding 263,000 jobs and the unemployment rate remaining changed at 3.7%. Now, why does this matter? Well, interest rates are contingent upon reducing inflation. Reducing inflation is contingent upon not that much money being spent in the system. On Black Friday, $9 billion were spent. On Cyber Monday, $11 billion were spent. 263 job openings, 63,000 job openings, when we expected 200,000, means that there were 63,000 new jobs from employers that needed to pay people a wage. And if they pay people a wage, those people will take that money, their wage, and they will go buy it on other things. In general, when we have a tightening economy, where we have quantitative tightening, where we have higher interest rates, people have to lose their jobs from an economic perspective in order to deflate, or essentially deflate the amount of money that's going into the system. If people are getting more jobs, they're going to get more money, they're going to spend more money. That means there's more money in the system. And so a hot jobs report, along with decreasing inflation, sends a little bit of a mixed signal to the Fed that doesn't really know exactly what to do, especially in the context of getting to that soft landing. Now, how to think about tomorrow. Nowcasting, a service sponsored by the Federal Bank Reserve of Cleveland, which makes projections regarding inflation, projects that CPI in November rose by 0.47% from October, which would likely be perceived as disappointing because the CPI rose 0.4% on a monthly basis in October. Nowcasting expects the CPI in November to be up about 7.5% in year-over-year terms, which would be an improvement from October. So some analysts are projecting that CPI numbers might be going up, and some analysts are projecting that CPI numbers might be going down. I think the majority of us feel that it's likely going to go down. The question becomes at how strong or fast as the rate of how it's going down, which is like the core thing that matters versus the top headline number. Now, the final thing to take into account when it comes to inflation, and again, my top level thesis takeaway from this is that even if inflation goes down, the rally we'll get should not be a rally that you are interested in my opinion, because that rally will likely just get eaten up by some of the other macro conditions that are going on, and that it's not the most sustainable rally in the world. We would have to see a major decline in inflation month over month consecutively in order to really feel that it's time to go heavy and load up. Final thing that's important to understand about this is energy. Energy massively affects inflation. Now, in the United States, at least, we've seen energy prices come down. And that's been for a variety of reasons. Some of this was just strategic oil reserves. Some of them were some of our other counterparties in the Middle East actually upping some of their production and helping us. But energy is going to be a big concern. The war in Ukraine is still going on from a geopolitical perspective. So with energy prices starting to come down a little bit, and we'll see how long-lived this is because it was lived for a little bit and then it went up and now it's starting to come back down again. That is going to determine a macro level argument about how much energy affected CPI data. And when we get CPI, we're going to know how much energy is actually affecting inflation as well. If energy starts to come down significantly, that is also going to be a very good sign for inflation, because even if the top line level goes from like 7.7 to 7.5, but we see that that energy in particular is reducing, that the used car market index, which is one of the big factors of inflation, is also reducing, that Cathie Wood's argument around deflationary pressures actually putting themselves into the market, the consumer sentiment report starting to go down, which means less people are buying stuff into the economy, which means that's good because there's less money that's being spent all around, which means goods and services don't have to compete for higher prices. There's more inventories. All of these different macro level factors, along with the fact that energy potentially is going down, could also signal that we are in a good spot, even if inflation doesn't get to like 6.5% or something tomorrow. If these underlying factors that are within the CPI report start to decrease and start to decrease pretty significantly, that could set up the foundation for CPI one day to take a massive drop, which maybe it's in January, maybe it's in February, maybe it's in March, maybe it's in April. But one day if we go from 6.9 to like 5.2, which that could happen if we have an overarching amount of data that starts to show that the economy is deflating, then that would be sort of the catalyst I think that we need for the Fed to pivot. Overall, I don't think this is a dip to buy. I don't think the Fed is going to pivot. I do think 50 basis points is likely if inflation somehow goes up, which I really don't think that's going to happen. But if it somehow goes up 75 basis points, it might not be off the table. And the Bank of Canada just 2 weeks ago raised their interest rates by 0.50%, 0.50 basis points. So that may also signal that it's unlikely that the United States does not follow in suit. But we will find out with inflation data coming out tomorrow. I'll be here on this channel. We'll talk about it. We'll go through all the numbers. Here we go. This is going to determine if we get that Santa Claus rally, or if we get a Santa Claus rally that's short-lived, or if we tank even harder if inflation does not come out consecutively down month over month. Thank you guys so much for listening and watching. I'll see you tomorrow.